We can understand the liquidity position of any business by performing liquidity analysis, and in that, current ratio plays a very important role. Current ratio is calculated as current asset divided by current liability. Here when I say current asset, these are all the assets which can be converted into cash within a period of 1 year. Similarly, current liabilities are those liabilities which have to be settled within a period of 1 year. If current asset is, let's say, 100 million and current liability is 75 million, then you can see there is a gap of 25 million. This 25 million, we can assume it has come from long-term funds, so we call it as net working capital. In this situation, if you calculate the current ratio, it will be 100 divided by 75 and you get the ratio as 1.33. So when the ratio is 1.33, what you can infer? When the ratio is 1.33, there is a 25% long-term fund contribution for build-up of current asset. And this is the reason many banks are insisting on this particular ratio, because by insisting 1.33, they are also insisting a 25% long-term fund contribution for build-up of current asset.